Hello and welcome to this managerial accounting video where we will be preparing a flexible budget. Recall that a flexible budget is a budget that is either based on the actual level of activity for the period, or it could also be based on different levels of activity as we're going to be seeing in this problem. Let's read what the data tells us. Beach Sports sells volleyball kits that it purchases from a sports equipment distributor. The following static budget based on sales of 2,500 kits was prepared for 2014. Fixed operating expenses account for 80% of total operating expenses at this level of sales. And here's our budgeted income statement. They want us to prepare a flexible budget based on sales of 1,000, 2,000, and 3,000 units. Okay, so the first thing we're going to do, as we always do, is to put a heading. So this will be Beach Sports Flexible Budget for the year ended December 31st, 2014. Okay. So across the top here, we're going to put the number of units, and we'll have 1,000, 2,000, and 3,000. Here we're going to have per unit amounts. All right, so one thing you always want to remember whenever you're taking information based on one activity level and converting it to another activity level, you're looking for unit amounts. The unit amounts are your key to solving these problems. Okay, so over here, the unit amounts are what we're going to need in order to get this budget started. So let's take a look. We have sales of $100,000 for 2,500 kits. So let's calculate our per unit amounts over here. We'll just put some calculations, okay? So we have $100,000 in sales. We're going to divide that by 2,500 kits, okay? And that's going to give us $40 per kit. Our cost of goods sold is all variable. Let's do the same thing. We're going to take our cost of goods sold, 60,000. We're going to divide it by 2,500 units, and that's going to give us a unit amount of $24. All right. Next thing, let's take a look at our operating expenses. Our operating expenses, they tell us, are 80% fixed. Okay, so our fixed amount is going to be 80% of 35,000. So take 80% of 35,000, and that's going to give us 28,000. So 28,000 of our operating expenses are fixed. And that means that the rest is variable, or 7,000 is variable. Okay, so now let's find our variable amount per unit. Again, we're going to do the same thing we did before. The 7,000 variable cost is for 2,500 kits. So if we divide 7,000 by 2,500, we're going to get $2.80 per unit. Okay, so now let's set up our income statement. We're going to start with sales revenue, as we always do. Our sales revenue per unit is $40. And our sales are going to be the number of units we're selling times the selling price per unit. Okay, so this is going to be equal to 1,000 times $40. Okay, and this is going to be equal to 2,000 times the $40. And again, 3,000 times our selling price gives us our sales for 3,000 units. All right, next let's take a look at our variable expenses. And we have two kinds of variable expenses here. The first one is cost of goods sold. And we know that our cost of goods sold is $24 a unit because we just calculated that. All right, so our cost of goods sold at each of these three levels is going to be equal to the number of units we're selling times the cost per unit. So this is going to be 1,000 times $24 a unit, or 24,000. This will be equal to 2,000 times $24 a unit, and then finally 3,000 times $24 a unit. Okay, our other variable expense is going to be the variable portion of our operating expenses. So let's put operating expenses here. And our operating expenses are $2.80 per unit. All right, same procedure. Let's take the $2.80, multiply it by 1,000 units, multiply it by 2,000, and then multiply it by 3,000. We're going to add up our variable expenses. So we'll add up our cost of goods sold. We can add up our per unit also. Okay, we're going to add our cost of goods sold plus our operating expenses all the way across. And that gives us our total costs. Okay, so next thing we have is contribution margin. Remember that contribution margin is equal to sales minus total variable expenses. Okay, so our contribution margin per unit over here is going to be equal to 40 minus the 26.80. So contribution margin is 13.20. Okay, here our contribution margin will be the 40,000 minus the 26.8, or 13.2. And I'm just going to drag that across. So for each of these, we're taking our sales minus our variable expenses, and that gives us contribution margin. Finally, what we want to do is subtract our fixed operating expenses. Remember that fixed expenses stay the same across every level of activity. So we're going to have 28,000 every time. Okay? And now we can calculate our operating income, which is simply our contribution margin minus our fixed operating expenses. All right, notice we have a net loss in the first case of 14.8. We still have a net loss at 2,000 units of 11.6. And then at 3,000 units, we have net operating income of 11,600. Okay, that's the end of this video. I hope you find it helpful in your studies.